back with Markets at Lunch right here on ET Now. Some traction in oil and gas, I must say. Petronet is up 3.5%, GAIL is up about 2.5%, and then of course you have the OMCs. Actually, Oil India is up about 1% too, and then you have the OMCs. So BP, HP, RSC, for obvious reasons, are trading well and truly in the green. So oil and gas seems to be having a fairly decent day in trade. Do watch out for these stocks. Take it on to our fundamental experts on the show. Mayuresh Joshi, fund manager at Angel Broking, joins us right now on the show. Mayuresh, good having you. Thanks for joining in. A question that we are revisiting almost with everybody. Oil and gas active, OMCs even more so. Clearly, the price hike suggests that the free pricing era is still very much intact. Do you use the weakness that has been there for the last few days to add on?
Afternoon, Neeraj. Again, if I break down the oil and gas space into upstream and downstream, the obvious reaction for upstream companies was a given with the crude prices moving up. The direct correlation that crude will have and the direct realization, because the gross under recoveries have gone down, there is no subsidy burden sharing on the upstream companies, is clearly playing out on their balance sheets. On the downstream part, clearly again, I think till oil stays in that range of $50 to $60 and rupee between 68 and 70. Again, I think significant gains can be made both in terms of the inventory gains that these companies will make, and within the product portfolio itself, they're looking at a lot of middle distillates. So middle distillates have shown quite a pump up in the past few months, and that will have a strong effect in terms of their earnings. And third, I think a large part of delta probably on the OMCs have got played out with crude coming down over the past few quarters, interest costs coming down, debt coming down. So to a large extent, I think the marketing margin expansion both on petrol and diesel has led to larger amount of EPS being played out. And again, largely it's going to be valuations at this point of time. So selectively in the oil and gas space, I think I would still say that if investors are holding on to OMC stock, continue holding on. Stocks like GAIL, Petronet can also have a decent performance in terms of their core operations, moving at a very steady clip over the next 2 to 3 quarters, to say the least.
What about the underperformers then, Mayuresh? Would it again be largely the consumption real estate names, or do you think the earnings weakness could very well trickle into other sectors as well?
Afternoon, Aish. I think very difficult to call the quantum of value and volume degrowth specifically for the consumer durable facing sector, and that can have a trickle down effect for sure in Q3. What probably happens in Q4 is largely unknown, but the larger part is that the earnings downgrades will start taking place and have already started taking place. Again, I think the recovery in terms of remonetization coming through normalization of economy, I think one really is not sure over the next few weeks how much of demand supplementation will actually start coming through once that happens. So FY18, the first half should be relatively better, assuming Q3, Q4 remaining extremely soft. So again, I think real estate as a sector, I think there is a lot of uncertainty on that front, and even the capex driven sectors, because I think the large consensus was that the second half should see some capex revival happening on the private side. The budget again will lay focus on the government capex coming through on infrastructure, power, roads and the rural economy. But the private capex has again got shifted from the second half of this fiscal conveniently to the second half of the coming fiscal. So I think capital oriented industries are also going to feel the brunt, as well as telecom in my opinion, which can underperform for the next 2 quarters with the leverage on their balance sheet, competition coming through, and that will have a say in terms of how ARPUs probably get compressed over the next 2 quarters, which will lead to earnings degrowth in my opinion. So largely I think these sectors might still feel the pain over the next 2 quarters, to say the least.
So Mayuresh, what would your call be amongst the bunch of spaces or opportunities that are available for investing right now at the broader end of the spectrum, not the large caps? What is the best bet?
Now again, Neeraj, largely as I said, because earnings uncertainty still looms on our market, and the dollar strength has been extremely evident in terms of what Trump will do. So in that sense, I think the emerging sell-off has been quite evident both in terms of bonds as well as equity markets. So to a certain extent, industries which will not get affected so much by the demonetization move and the slowdown that you'll probably witness both in terms of earnings and the GDP contraction. Again, my sense is that gas distribution companies should do reasonably better. Largely again, power as a space is something that I've liked. I'll continue to like that space because the government focus, in my opinion, over the next few quarters will be large on power. So power transformers, power distributors should do reasonably better in my opinion. And lastly again, I think one really needs to have a bottom-up approach in terms of selective mid-cap names. So again, within that pack itself, I think one really needs to do cherry picking. I think of select few stocks from the print media is something that I'll continue to like. And again, I think within the large cap, I think being extremely selective in terms of pharma and financials.
Right. What about the near term for the market though, Mayuresh? Does it seem like we're going to continue to be range bound or maybe even lackluster from here onwards, considering the Parliament winter session has been, you know, a bit of a damn squib? You've got the big event, that's the Fed rate hike, which is now done and dusted with, and because of it being year end, does it seem like we could now get into a bit of a a limp sort of mode for the markets up until January when the earnings kick in?
Oh, absolutely, Aisha. And again, I think the softness or the consolidation for the markets can very well continue. I think most of the triggers, both from an Indian and a global context, are largely out of the way. I think the next big trigger that the markets are probably looking out for is the budget, because the general consensus, as I've been saying, is that Q3 earnings are going to be extremely soft. So I think the budget will be a determining factor on the domestic front for the Indian markets. And even from foreign perspective, I think even though the dollar rally has been extremely strong, the US economy is showing signs of resilience. Within the emerging pack, I think if the budget is testimony to what might get played out, I think India still would stand out. So I think it's just a matter of time that flows can resume, albeit at a lower or a slower pace, but largely I think the domestic flows will largely compensate for that, and we've already seen huge amount of money coming through in terms of savings, and the expectations is that large money will still keep on flowing through over the next few months. So largely again, I think expecting the index rather to stay range bound. It's going to be more stock specific, and I think budget is going to be the determining factor and the trend for the markets going forward.
Thanks a lot for that, Mayuresh. Good having you as always. Thanks for taking the time out.
Thank you so much.
That's the view from Mayuresh Joshi of Angel Broking. Hear out one more big voice. Saurabh Mukherjee of Ambit Capital says he sees a 10% downside over the next 6 months if DIs and FIs pull out.
More than IT, I think historical records suggest Indian pharma gives you a linkage to growth recoveries in the West. And in that regard, not only is the pharma sector reasonably